Hi guys, my name is Amor De Libasic, a financial advisor with over a decade's worth of experience, and today we're going to go through a Q&A where we go through some questions that are held just off screen, which help us explore different financial topics in Australia and questions you guys have for me. So the first question, what is the simplest way to start investing in Australia if I only have a small amount of money? I suppose this really depends. It depends on your age, it depends on what you define as a small amount of money. But the very first goal that I try and help people achieve is getting into their own property. There's a number of reasons for this. I think you can argue as to whether buying your own home is investing or not, but there's a value in being stable and in knowing what your housing situation is going to look like. There are quite a few benefits and grants and assistance packages that the government's put together to actually help people get into their first property. And so you don't need a large amount of money to get into your first property. You know, in Sydney, if you're buying a property and you wanted to buy it for $600,000 with all the different combinations of schemes, you would potentially only need to have saved $30,000. So if I look at a couple of different strategies, a couple of different paths, and I were to say, okay, well, one solution might be you take that $30,000 and you invest it in a portfolio of diversified index ETFs. That's a good investment strategy. Index ETFs I strongly believe in, and I think there's a very strong basis in them, but it's a non-leveraged position. You don't have that power of leverage giving you access to a force multiplier on your investment the same way that property potentially does. So if I were to take $30,000 and purchase a property as opposed to put that $30,000 into an ETF, then if I were to run those two scenarios over a period of 10 years, I think you could make a very, very strong argument that the strategy where you purchase the property is going to be significantly stronger than the strategy where you purchased the ETFs. The strategy where you purchase the ETFs, depending on what you bought, may double over a 10-year period. The strategy where you purchase the property, if you say, for example, that you equivocated the rent for the interest payments and you had a 2 to 3% real return on the property every year, well, even though that's significantly less in terms of the let's say percentage return the property had actually given you, the fact that it's a leveraged position means that the nominal value of the funds that you have at the end of that 10-year period is probably significantly more. So a 30% increase in the value of a $600,000 property is $180,000. Compared to the $30,000 that the ETF generated, it's significantly more, plus you've had the value of the stability of your own home, the grounded nature that gives you, and the solid foundation that then allows you to move forward into more exploratory financial waters, if you will. How can I maximize my superannuation contributions without compromising my current lifestyle? It's a good question. Once again, it depends on what's your lifestyle. Do you really want to maximize your concessional contributions? Your concessional contributions max out at $30,000 per annum. You've also got the carry forward cap over the last 5 years, which, like the old mobile data plans, if you haven't utilized your concessional contributions, accrues. So to maximize your contributions would be, for most people, a pretty aggressive feat. But let's interpret this as meaning, how can I make a meaningful contribution to superannuation? I think a very easy place to start would be salary sacrificing. There's a couple of reasons for this. One, salary sacrificing comes from your pre-tax income. So the actual cash flow implication of salary sacrificing is significantly less than the cash flow implication if you were to just put money in as a post-tax contribution. The next thing is salary sacrificing comes out before you actually see the money. That money gets taken out by your employer and put into your superannuation before it actually hits your account. Because of this, you probably won't notice it as much. It'd be the same as if taxes increased slightly. You might not like it, and for the first 2 to 3 months, you may feel it, but it's likely that over time, the impact of that will be forgotten. And so you'll be in a position where once you've had a little bit of a pay rise, that salary sacrifice agreement that you've put into place with your boss is more or less negated from a cash flow perspective. The last thing is that it's automated. So you can look at a number of different studies. They're all pretty consistent on this. Human beings are, for the most part, pretty terrible at maintaining a high degree of motivation. Anything that requires manual and consistent effort is at a very high risk of failing, whereas anything that you automate and that you keep out of sight is more likely to succeed. So if you're trying to make a meaningful contribution to your superannuation, a good place to start is salary sacrifice. Now don't forget, your concessional cap is $30,000 a year, and your employer contributions, your superannuation guarantee contributions, will count towards that. So if you're not sure, definitely talk to an advisor or an accountant so that you don't breach your caps. How do I balance paying off a mortgage versus investing? This is another question, like all of them, which the true answer to is it depends, but I can give you a framework. In general, paying down debt, I'm not a huge fan of often. Situation-specific circumstances arise where paying down debt makes sense. If we're looking at negating debt, I would much prefer the use of an offset account. It improves your liquidity position. The more liquidity that you have, the more secure you are in your finances, the more that you can actually take a hit and roll with it. If you have no liquidity, you're kind of walking a tightrope. But if we look at, let's say, offsetting debt or paying down debt versus investing, we need to think about what each of these decisions is achieving. The pay down or offset of debt is immediately decreasing the cost of debt and arguably improving your liquidity and financial stability. Investing achieves some of these outcomes, but not immediately. With investing, you're taking on more risk. There's a risk-reward relationship. And so if you invest, you're on balance of probability, if you invest in growth assets, going to generate a higher return than just paying down debt. And so if we were to compare two strategies, for example, concentrating on just paying down debt or utilizing a debt recycling strategy where you pay down debt and then borrow that back to invest in quality growth assets, potentially an investment property or a geared shared portfolio. And you would ask me the question, which of these two over a 15-year period is likely to be more powerful? It's very likely that the investing strategy is going to be more powerful. Now, the caveat to this is, with finance, you need to make sure that your current position is stable before you take the next step. Before you move forward and leap into exploratory financial waters with investing, you need to ask yourself, how is my cash flow? Do I have enough liquidity? Have I accounted for any unforeseen expenses which might require cash or a capital injection? And then once you've made sure that your current ground is secure, then you can take the next step forward. What role does an emergency fund play, and how much should I have set aside? This is a fantastic question. I think one that's not asked often enough. Often people think about creating wealth and forget about protecting wealth. If you look back at the last 100 years and you consider the question of how much do I need to have in my account in order to be stable? If you want to take the approach of catastrophizing, you would look at, well, what are the economic events that have occurred that have forced people into a higher percentage of unemployment? And then how long did that unemployment last? Now, if you look at those different events, unemployment can double overnight. So still the vast majority of the population is employed, but there is a significantly higher risk of unemployment. The worst of these was the GFC. If you look at America during the GFC, there was a significant, more than doubling of unemployment. And then the real issue with this was that to a degree it was structural unemployment. There just weren't jobs for those people to go into. And so for many people it took 12, 18 months to actually get back into a role. So what I would suggest that you look at is look at the position that your household is in, how you would fare if you're a double income household, if one person was unemployed. How much do you need in cash to at least make it 6 months? My ideal for clients would be to have at least 18 months to 24 months. But for many people, that initial step might seem like an impossible goal. So as a starting point, I would suggest have a look at your position. What do you need to have in cash, in an offset account or in savings to be able to last at least 6 months? And then I would personally get very uncomfortable if we were in a position where we didn't have that liquid cash or savings available. Final question. How do interest rate changes by the RBA really affect my investments and my loans? There's a couple of things to understand. The RBA is impacting interest rates in order to try and control its 3 mandates. Its first primary mandate, the mandate above all others, is to control inflation. Inflation's got to be between 2 to 3%. Then what the RBA wants to do is keep unemployment as low as possible, so to work towards full employment, and then to keep the Australian currency strong. Now, when they push and pull bonds in and out of the market, it changes the cash rate and the rate at which Australian lenders can borrow, and then therefore that has a flow-on effect through the entire interest rate architecture of the country. Interest rates changing fundamentally will impact the cash flow implication of an investment and the net present value of the investment as calculated by the discounted cash flow over time as seen in the present moment. That sounds a little bit complicated, but what that means is an investment pays you, let's say, monthly. And in finance, we want to look at those monthly slices and see what's the value of those slices. So if interest rates go up, the actual amount of money that you'll receive net from the investment will decrease, and then the assessment criteria for the actual value of that money over time decreases. So increasing interest rates from one perspective also decrease the time value of money. And so increasing rates really does have a substantial impact on the profitability of an investment. These things, if you look historically, really are cyclical. They go up, they come down. The RBA has to pull, then it has to push. So with an investment portfolio that you're already exposed to, the main thing to make sure that you have in order to be secure with your investment when rates are going up is sufficient cash flow and some kind of liquidity buffer. So yes, the government will increase interest rates like they have recently off the back of the COVID pandemic. That's going to impact your net return. There's no way about it. But the last thing that you want is to be in a position where those high rates actually force you to exit from an asset when it's at a suboptimal price. So cash flow and liquidity in times of increasing interest rates are fundamentally important. I hope that was useful for you guys. As always, I'd love more motivation. For questions or comments that you have, leave them in the comment section below. We'll try and get to them as quickly as possible. My name is Amor De Libasic. Have a good night. Goodbye.